Hello everybody, welcome back to the 10th of an hour with Griffin Bridgers, where I challenge you to replace a 10th of an hour of billable time with a 10th of an hour of learning during your day. For today's episode, episode 2, we're going to talk about tax gray areas dealing with transactions with grantor trusts and revenue ruling 85-13. Now, in yesterday's episode, episode 1, we briefly introduced the concept of grantor trusts and how a sale between a grantor and a trust was typically disregarded for income tax purposes. But the genesis for that was that the grantor of a trust under the grantor trust rules could be treated as the owner of the actual asset being sold or exchanged. And that's the nexus of today's revenue ruling 85-13 that we're going to look at. Now, this revenue ruling is often cited for the purpose of disregarding the income tax effects of a sale between a grantor and a grantor trust. But today we're going to dig a bit deeper into this revenue ruling to look at some gray areas that are often ignored by practitioners who cite the ruling as support for income tax fictions. So the facts of this ruling are that the grantor had created an irrevocable trust and transferred 100 shares of stock to that same trust, and the grantor's spouse was the trustee of that trust. So the grantor's spouse was a related or subordinate party. So there is no firewall between grantor and trustee level decisions. And why that's important is because the grantor then borrowed the stock in the trust in exchange for a promissory note payable from the grantor back to the trust. And the stock had gone up in value from the time of the initial funding of the trust to the time of the borrowing. So the principal amount of the note was equal to the value of the shares at the time of borrowing and not at the time of the initial gift to the trust. Now, the note was unsecured but did bear adequate interest in the eyes of the IRS. Now, the outcome of this ruling was that the service generally found that when the grantor trust rules apply, that sales or exchanges between the grantor and the trust are not subject to income tax. In other words, if you're the grantor of the trust, you're essentially treated as if you sold an asset to yourself if you sell an asset to the trust, or if a trust sells the asset to you. And you're not taxed if you sell an asset to yourself. So that's the ultimate outcome of this ruling. Another important piece is that there's no change to cost basis in transactions between the grantor and the grantor trust if those transactions are not taxable. Now, there are some limitations and gray areas in this ruling that often aren't cited or recognized by a lot of practitioners who rely on this ruling. One important note that ties into yesterday's coverage in episode 1 is that the ruling only applies in a situation where the grantor is treated as owning the same consideration before and after the sale that is being disregarded. So the usual safe harbor when you have a grantor trust is that you want to treat the grantor as the owner of all trust assets. That's where this is most effective. And usually to get there, you have to use a swap power under the grantor trust rules, and that's usually the power held by the grantor to exchange assets that the grantor owns for assets of the trust that have equivalent value. But Revenue Ruling 85-13 didn't invoke this swap power, which is the most widely used and popular grantor trust power. Instead, Revenue Ruling 85-13 used a borrowing power. And what that power does is it recognizes the grantor as the owner of borrowed assets if the grantor has actually borrowed assets from a trust in exchange for a promissory note. So what this revenue ruling found is that the grantor owned the promissory note before and after the sale. So the sale of any other trust assets beyond that specific promissory note could be taxable to the trust if the grantor wasn't also deemed to be the owner of those assets. So as I noted earlier, when you're looking at the grantor trust rules, you need to take an asset-specific type of stance and make sure that the grantor owns the asset being sold before and after the sale if you want that sale to be disregarded. It's also important to note that this ruling is limited to the income tax effects of transactions between the grantor and the grantor trust, and it does not address the effects of the estate tax rules. So importantly, you should note that Code Sections 2036 and 2038 could still apply. So if a grantor swaps assets with a trust, or borrows assets from a trust in exchange for a promissory note, the IRS still could dig into that transaction and find a gift, or they could find that the grantor has retained so many powers over the trust that the assets of that trust could get pulled back into the grantor's gross estate at the time of death for estate tax purposes. Thank you everybody for joining me today. As always, if you have questions or topic suggestions, please feel free to email me at griffin.bridgers@gmail.com. Thank you again, and I look forward to seeing you in the next episode of the 10th of an Hour.